Hey guys, Don Yoakum here. Okay, we got a lot of data coming out over the next few days, and I want to do a quick preview, do a little something different. We're going to look at labor markets. We're going to talk about inflation. Some of the and some of the labor market numbers have come out this week, and we got a little bit coming next week. Sorry, we're going inflation and also the retail sales, which has kind of been a sticky wicket, I think, over the last few months. Okay, or at least during last month, right? Okay, here we go. We'll start off with the labor market. All right, so for context, last month, so here we have the unemployment rate, right? And this is going back to 2006, and it got up to around 10% during the global financial crisis, and they really started to redefine what the labor pool was. That number was a lot lower. That 10% unemployment was a lot lower than it otherwise would have been had they not changed their methodology. Anyway, we had a really incredible decrease down to around below 4%. And then COVID struck, and now we're down to 3.4%, which is, the lowest it has ever been, period. Okay. 50, 60, 70 years. It's the lowest we've ever been. Now, part of that has to do with the way they've redefined the labor market. But I think a lot of it has to do with, I've talked about this before. We've got a massive pool of baby boomers removing themselves from the job market by retiring, right? That is keeping the job market exceedingly tight, and that's a problem for the Fed, right? That's wage price spiral inflation is something that you've all heard about. I've talked about it a lot, but anyway, with that in context, we're down at 3.4, and expectations for next month. Expectations for the next number is also right at 3.4%, and that's tomorrow, right? So we'll see. I don't expect any real big surprises there, although the number of jobs created, right, here we go. Recall that the number of jobs created last month was 517,000 versus expectations of 225,000. Now that was something like a Six Sigma, which is a 1 in 10 million. I don't even know. A deviation from expectations, right? That was a massive miss. There's lots of statistical anomalies driving data across the board because we are in a choppy turning point, right? The models can't handle the inputs. And statisticians are just going nuts because they're used to trimming here and cutting here and assuming this and straight lining here, and it's in reality is saying sorry, buddy. But anyway, that was a huge surprise. All that job creation, and we'll see what we get tomorrow. This also, for context, we had job openings fell and jobless claims rose, right? So both of those point to a slightly weaker labor market. But earlier this week we had ADP employment, which is like a payroll processing, right? So they just look directly at their numbers. It was more than double last month's of 119. I think it came in at 242,000, right? So that's a strong market. So we'll see. And then also we've got hourly wage growth will be very closely scrutinized, right? And the expectations are for a 4.8% hourly wage growth year over year. That's almost 5% wage growth year over year. That's uncomfortable for the Fed versus last month's 4.4. So they expect that to go go higher, and who knows if we'll see even higher than that, right? If it'll exceed those higher expectations. Okay, that's part of the labor market. Oh, there's another point I want to make here. Real wages. So this is all part of the employment labor discussion. We get real wages next week. Here we're going back to the 80s, right? You don't need to pay attention to all of this. But what you see here, real wages, again, they peaked during COVID in the stimulus and dropped off dramatically, but they're turning higher here. So real wages, average hourly earnings, all that stuff is another close number that's coming out tomorrow, I believe. Oh no, that's early next week. Yeah, so right there, early next week. Okay, here we go. We got inflation. All right, so here's a couple of gray numbers. So we got headline inflation, headline CPI, consumer prices, and core CPI. Core CPI excludes food and energy. headline is just the whole shebang, right? And economists, the Fed really wants you to ignore this number here on the left, and they want you to focus on the number on the right, but the number on the right really isn't telling them what they want to see either. So, all right, we're looking at, now I haven't seen estimates on these yet, but last month, the annual rate for headline came out at 6.35. And we had what was uncomfortable, again, was this month over month. So the orange here is the month over month changes, and the big gray lines are the year over year. And month over month, we had this creep up to 0.52. That was unfortunate. They didn't want to see that monthly increase in inflation. So, not that we've bottomed, but certainly we, as it's eased, as inflation pressure is eased, it seems like they're turning, right? And you'll see that over the next few charts. And the same, likewise, so the 5 core, did come down on a year-on-year basis at 5.55%. And, it got a little, but on a month over month, it creeped a little higher too. So that's going to be, those month over month changes are going to be highly scrutinized. I wouldn't, frankly, I think they're going to come in higher than both on an annual basis and a month over month basis. I think we're going to see higher prints on both core and headline next week. All right, and that's going to basically lock in a 50 basis point hike from the Federal Reserve. I believe it's the following week. Okay, what do we got? Producer prices is also coming out next week. So you can see here, and here I have, this is just a trend line index. Okay, there's a number that they publish. And then the green is the year over year, so the annual rate, and then the orange is the monthly. Well, you can see this nearly 1% increase in producer prices in 1 month, right? It's 0.79% right here after declining, a few months decline. So, all right. Annual rates running at about 5.6%, but you can see that this shift to a higher monthly rate was enough to start turning this PPI number higher again. It peaked back last summer, and it could be turning higher. So, that'll be interesting to watch too. And then finally, retail sales. That was last month. This here, the orange is again the month over month, and this is at 2.43%. That was a huge surge in retail sales. We talked about this on a roundtable yesterday. Look, I think what's happened, because banks have been sitting on a ton of cash. All the quantitative easing created over the last several years, basically just sitting as excess reserves, hasn't been lent out, hasn't turned into loans on banks. And now, so the money's still there. The Fed's starting to pull a little bit of that money out, but most of that money is still there. And frankly, the Fed is pretty far behind what they expected to be doing so far, because I don't think money markets, short-term capital markets, can handle them removing as much money as they want, as they said they were going to remove. But anyway, so we've got what happened is the Fed started raising rates, borrowing costs went up, credit card rates, personal loan rates, mortgage rates, auto rates, all of those things went up, and people, and plus people are getting squeezed by inflation, so they're having to turn to their credit cards. Anyway, all of that is pushing people to borrow, right? It's paradoxically creating more money. It's creating more credit. It's encouraging people to borrow more money by raising interest rates, because they're trying to get as much as they can before rates get too high. And you're starting this. That's what I think that had a big part of this retail sales figure. Plus, China's opening back up, right? There's some, money flows back and forth, blah, 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 blah. And you can see the retail sales turning, that was enough to turn retail sales higher here, the overall index. So we'll see how that goes. All right, guys, that's the numbers we got. It's been really, really slow on the data front over the last few weeks and last couple of weeks, but we're turning back up. All of this, the last several Fed hike cycles, or last several Fed meetings, CPI came out after the meeting, not right before or the week before. The Fed says they're data dependent. Powell spent the last 2 days in Congress saying data dependent, data dependent, data dependent, over and over again. We look at the data. We're driven by the data. Well, he's going to have all the data he needs right now. And, like I say, I think they're going to come in with a full 50 basis point punch. And they're going to, and the markets are not prepared for that. And they, even though they've tapered off a little bit over the last week or two, that's going to come as a pretty significant shock. Anyway, that's my numbers. Hope you can download the links, download the link to this slide, follow along, and I'll catch y'all later. Thank you.